If you make $40,000 a year, you might think wealth is out of reach. Social media shows six-figure earners investing thousands per month, buying property, and living freely. But here's what most people miss. Wealth is not about how much you make. It's about how much you keep, invest, and compound over time. Plenty of high earners stay broke, while disciplined middle-income earners quietly build real net worth. In this video, I'll show you exactly how someone earning $40,000 per year can build serious wealth step by step without risky shortcuts, unrealistic side hustles, or financial stress. Step 1. Know your real numbers. At $40,000 per year, your monthly take-home pay after taxes might land somewhere between $2,500 and $2,800, depending on where you live and your deductions. That means every dollar must have a clear job. Wealth building begins with awareness, not income size. If you don't track where your money goes, you'll never truly control it. Start by listing your fixed expenses like rent, utilities, insurance, and transportation. Then calculate your variable spending, such as groceries, dining out, subscriptions, and entertainment. What remains is your surplus, and that number determines your wealth building power. Even identifying an extra $300 to $500 per month creates serious momentum over time. Most people feel stuck not because they earn too little, but because their money leaks silently. Clarity turns confusion into strategy. Once you understand your financial flow, you can intentionally redirect surplus income towards saving and investing instead of letting it disappear unconsciously. Step 2. Build a financial safety net. Before you focus on investing or growing your money, you must first build stability. An emergency fund protects your progress from being wiped out by unexpected expenses like medical bills, car repairs, home maintenance, or even temporary job loss. Without protection, one surprise can push you into debt and undo months of effort. Start small with a $1,000 starter emergency fund. Once that's in place, gradually build it up to cover 3 to 6 months of essential living expenses. Keep this money in a high-yield savings account where it remains safe, liquid, and separate from your daily spending. This fund is not for vacations or shopping, it's strictly for real emergencies. Financial security reduces stress, and lower stress leads to better long-term decisions. Think of your emergency fund as the foundation of a house. Unseen, but absolutely necessary for everything built on top of it. Step 3. Lock your lifestyle. One of the biggest traps for someone earning $40,000 is lifestyle inflation. The moment income rises, even slightly, spending tends to rise with it. A small raise becomes a reason to upgrade your phone. A tax refund turns into a vacation. A bonus becomes a newer car or more subscriptions. These upgrades feel harmless, but over time, they quietly slow your wealth-building progress. The solution is intentional restraint. Choose a lifestyle that is comfortable but controlled, and commit to maintaining it even when income increases. When you earn more, automatically direct the extra money into investments instead of expenses. Wealth accelerates when your income grows, but your lifestyle stays stable. Acting like you earn slightly less than you actually do creates automatic investment power. Discipline in spending compounds just like money does. Long-term financial freedom is built by resisting short-term upgrades that feel good but delay lasting wealth. Step 4. Protect a 20% investment rate. Even on a $40,000 salary, aiming to invest around 15 to 20% of your income is transformative. That could mean $400 to $600 per month depending on your expenses. Use automation so the money transfers to your investment account the day you're paid. When investing becomes automatic, it becomes consistent. Consistency is more important than intensity. Some months may feel tight, but long-term discipline wins. If 20% feels impossible at first, start with 10% and increase gradually. What matters is momentum. Protecting your investment rate is more important than chasing high returns. The percentage you invest has more impact on your wealth trajectory than trying to pick the perfect stock or timing the market. Step 5. Invest simply and broadly. Complex investing strategies often hurt smaller portfolios. Instead of stock picking, day trading, or chasing hype, focus on broad market index funds with low fees. A simple structure could include a total stock market index fund combined with a bond fund for stability, or even one global index fund if you prefer simplicity. Historically, diversified markets have delivered long-term growth around 7 to 10% annually. The goal is not excitement, it's steady compounding. Avoid checking your investments daily. Avoid reacting to headlines. Wealth builds quietly over decades, not weeks. The simpler your strategy, the more likely you are to stick with it. And staying invested is where the real growth happens. Step 6. Eliminate high-interest debt. High-interest debt is one of the fastest ways to destroy wealth-building progress. If you're paying 18 to 25% interest on credit cards, your investments will struggle to outpace that burden. Prioritize paying off toxic debt aggressively before investing heavily. Use structured repayment methods like the avalanche method, focusing on the highest interest rate first. Once the debt is gone, redirect those same payments into investments. That creates powerful momentum. Financial freedom requires removing obligations that drain your income. Debt elimination increases your cash flow, reduces stress, and accelerates savings capacity. Building wealth on $40,000 becomes significantly easier when interest payments stop consuming your financial energy. Step 7. Increase income strategically. While discipline matters more than income at the beginning, increasing your earning power multiplies results. Focus on skill development, certifications, negotiating raises, or job changes that increase pay without drastically increasing expenses. Even moving from $40,000 to $50,000 while keeping the same lifestyle dramatically boosts your investment capacity. The key is upgrading income while resisting lifestyle inflation. Side income, freelancing, or specialized training can also create leverage. But never delay investing while waiting for higher income. Start now, then improve income gradually. Wealth acceleration happens when rising earnings are paired with steady investment habits. Step 8. Master time and patience. Time is your greatest financial asset. Someone investing $500 per month at an average 8% return could accumulate hundreds of thousands, even approaching 7 figures, over several decades. The earlier you begin, the less you must contribute later. Compounding works slowly at first, which is why many people quit too early. The first 5 years feel insignificant. The next 10 years feel encouraging. The final decade feels exponential. Patience separates wealth builders from everyone else. Markets will fluctuate. Headlines will scare you. Stay consistent anyway. Wealth is built by those who continue investing when progress feels boring and invisible. Building wealth on $40,000 isn't about earning more than everyone else. It's about managing better than most. Start small, stay consistent, and let time do the heavy lifting. If this helped you, like and subscribe for more practical financial strategies, and comment below, what percentage of your income could you start investing this month?